P8.1. This exercise is a little bit longer. At December 31st, 2019, Catu Medical reported the following information on its statement of financial position. During the year 2020, the company had the following transactions related to receivables. And let's take a look at letter A. Prepare the journal entries to record each of these 5 transactions. Assume that no cash discounts were taken on the collections of accounts receivable. Okay, so for the first one, it says sales on account. Well, if it is on account, that means that accounts receivable has to go up. Maybe I can make the screen bigger like this. Accounts receivable has to go up, and since it is a sale, I gotta have sales revenue, right? How much was the amount? It was 3,700,000. Two, sales returns and allowances. Well, if I have sales returns and allowances, that means that my sales revenue actually has to go down, right? So I'm going to write sales revenue over here at the bottom. Sales revenue, it is a credit balance, which means that it is a minus and a plus. And this position is a minus, which means that I am reducing, I am deducting from my sales revenue because I had returned. Some people returned some of my merchandise. That's why I have it on the top. And accounts receivable also has to go down because originally, if I had successfully sold this product to my customer, I would have some receivables from them. But now, since they return some of my products, then I have to reduce this accounts receivable. And since accounts receivable, it is a debit balance, it is a minus and it is a plus and a minus. In this position, it is a minus, so I am reducing it. How much is that? That is 50,000. Three. Collections of accounts receivable. That means that I collect cash and my accounts receivable has to go down because I already collected. So accounts receivable goes down again. How much is that? That is 2,800,010. 4. Write-offs of accounts receivable deemed uncollectible. Okay, so as you remember that I said that when you write off something, it's kind of like saying that you give up, that you're not gonna, you know that this customer is not gonna pay you anymore, right? So because you know that this customer is not gonna pay you anymore, you have to deduct the allowance that you previously prepared for this kind of situations, right? And this account we call allowance for doubtful accounts. And we also have to deduct accounts receivable again because this person is not going to pay me, right? So I don't have nothing to be received from them. And the amount was 90,000. Excuse me, 90,000. 4. What about the 5? 5, recovery of bad debts previously written off as uncollectible, which means that after you have this entry for write-off, originally this was 90,000, right? You thought that from this 90,000 amount, you're not gonna get not even a dime of it. But it turns out that somehow you got a part of it. You got 29,000. So you kind of have to cancel this entry, but not the whole entry because you didn't get 90, right? You just got 29. So what do you do when you want to cancel the previous entry? For you to cancel an entry, you just have to reverse the entry. So for this part, we're going to have 2 entries. The first one is the reverse entry. So we're going to reverse this entry here. How do we reverse it? We simply just write the same accounts, but on the opposite position, just so we can cancel it. So over here, we're going to have accounts receivable at the top and allowance for doubtful accounts at the bottom. Make sure that you write the full name, okay? I'm just doing this to save time. And here, even though you're gonna feel tempted to write these numbers, but you cannot. Why is that? Because it was not the full amount, right? It was only 29,000. If you write 90 both here, that means that you completely cancel this previous entry here, and it turns out that besides the 29,000, the rest of it is just going to continue to be uncollectible, right? So we cannot write 90,000. We have to write 29 because this is the amount that was actually collected. And this is the first entry. The second entry is going to be the collection entry. You got this money, right? You got this cash. So cash has to go up and accounts receivable has to go down because this account that was supposed to be received was received, and it was received in cash. So we're going to have accounts receivable goes down and the same value, just like this. And that is number 5, and that is letter A. Okay. B. Enter the January 1st balances in accounts receivable and allowance for doubtful accounts. Post the entries to the two accounts, use the accounts, and determine their balances. Well, for you to know the balances, that means the ending balances, right? For accounts receivable and allowance doubtful account, you really have to use the accounts. There's no other way. So we're going to have to make the accounts for both accounts receivable. So over here, I'm going to have accounts receivable and we're also going to need an allowance for doubtful accounts, the account. Again, do not write the way that I am writing, like this D here, because in the exam you're supposed to write the full name. Okay, well, accounts receivable, it is debit, so I like to put the balance here, the signs here on the top for you to for me to remember it better. So accounts receivable is a debit balance, which means that the increase is the values happen here, right, on the debit side. So it is a plus and a minus. And allowance for doubtful account is the opposite because it is a contra accounts receivable account. So the signs have to be the opposite. So it is a minus and a plus. So the increases happen on the credit side, on the this side over here. Okay, so now we're gonna see. We're going to determine the ending balances. First, let's do the accounts receivable first. Well, if you pay attention, in the beginning, we had a beginning balance for the accounts receivable, right? This number, do you see? They reported the following information on this statement of financial position, which means that they said that this is the beginning value of their accounts receivable. So we're going to have a beginning balance of 960,000 reais. This is the currency. Okay, so if it doesn't say anything, every time if it doesn't say anything, that means that the balance is positive. It is on the positive side, which means that that number that we just saw, I'm going to put it here. And in the future, for allowance of accounts, I would write that number here, right? Okay, so here, the beginning balance, it is this, correct? Okay, this is the beginning balance. Plus, but we actually have some changes throughout this year, right? So we're gonna have to write these numbers over here. Accounts receivable, debit of 3,700,000. Okay, and then we had a credit of 50,000. Credit of 2,810,000. Credit of 90,000. Debit of 29,000. Last but not least, credit of 29,000. Okay. So they want to know the balances, right? They want to know what is the ending number after we add and subtract all of these numbers. When you have something like this, the easiest way is to add each side and then see which one is bigger and then like deduct from the biggest one. So for example, for this side over here, let's see how much do we have. For this side, you're gonna have 4,689,000. Yeah. For the other side, the credit side, let's see how much do we have. Over here you have 2,979,000. Yeah. Okay. What do you do now? Well, since this number is bigger than this number, that means that we're gonna have more here, right, on this side. So I just subtract this from this. And that gives me that gives me 1,710,000. This is the ending balance on the accounts receivable side. Now we have to do the same thing for the allowance doubtful accounts. Do we have a beginning balance for that one? We do, right? Allowance of doubtful accounts is the beginning balance, so it is 80,000. If it doesn't say anything, it is a positive, right? On this T account, the positives are on the right, so 20,000 has to be in this side. What about the changes during the year? Let's see. Debit of 90,000. Credit of 29,000. And then I believe that's it, right? Yeah, that's it. Okay, so we just have these three. Well, for this side, we just have 90, right? For this side, we're gonna have, yeah, we're gonna have 109,000. Okay, same thing. Since this number is bigger than this, which means that we're gonna have more in this side. So let's just subtract the 90,000 from the 109. Okay, so we're gonna have an ending balance of 19,000, and that's how you calculate the balances. C, prepare the journal entry to record bad debt expense for 2020, assuming that the aging of accounts receivable indicates that expected bad debts are 115,000 reais. Okay, every time you see record expected bad debt expense, they are talking about this account here. And even though we just did this, I really recommend you to do it again, like to also have a new allowance for doubtful account, T account over here, because you might get confused if you want to enter some numbers here, and you have to have this as an answer anyway, so you just have to make another one. So allowance for doubtful accounts, again, it is a minus and a plus. And over here, these numbers, they don't matter anymore because we already have that the previous ending balance was 19,000. So we're just gonna put some dots here to show that something happened before. We had some numbers before, and currently the balance, it is 19,000. But this is not the final balance. Why is that? Because here they said that the expected bad debts are 115,000 reais, which means that the expected final balance is going to be 115,000 reais. So we're gonna have to put it here, right? Because it's the expected final number. And then we just have to figure it out. How much do we need in order for this 19,000 to become 115,000? Well, we're gonna have to add something, right? We're gonna have an X, and this X is what we call bad debt expense. So here, since we are on the positive side, this is a plus 19,000, right? So just 19,000 plus X is going to be 115,000. Let's say that this 19, for example, was over here. We would have minus 19,000 plus x equals 115. Since it is here, we are on the plus side, like that. So we're going to have x equals 115,000 minus 19,000. That is 96,000. And this is my bad debt expense. So now we have to make an entry to record this bad debt expense. So bad debt expense has to be debited because it goes up. Since this is an expense account, it is like an asset account, right? It is a plus and a minus. The debits, the increases happen on the debit side. So in this position, it means that this this bad debt expense is going up, and it is going up, right? Because like somebody's not going to pay us, so that's why this expense, this bad debt expense is going up. And then we're gonna have some allowance for doubtful. Write the full name, okay? Accounts. Allowance for doubtful accounts, it is a minus and a plus, which means that this account is going up, right? Because I'm realizing that I'm going to have to spend money because of this bad debt. So I have to increase my allowance. This is why. And the amount is just 96,000. Okay. Let's see letter D. Compute the accounts receivable turnover for 2020, assuming the expected bad debt information provided in letter C. Well, for this one, you're going to need some formulas. The first formula that you are going to need is the average net accounts receivable formula. That is beginning net accounts receivable plus ending net accounts receivable divided by 2. Okay, so here let's make sure that we highlight this because we're going to be using this is the first formula that we're going to be using. Okay, so this is divided by 2 because this is an average, right? This is net because all of these are nets. And net just means that you're going to have something that it is like the ending value minus the beginning value. And this is accounts receivable because all of this is accounts receivable. Okay, well, let's see. What is the beginning net accounts receivable? Well, let's take a look over here. This is the original accounts receivable, correct? Yes. But we always have to deduct the allowance for doubtful accounts for us to know the actual amount of accounts receivable that we have. And this is going to be our beginning net accounts receivable. So it's just going to be this minus this, okay? So we're going to write this over here. That is 900,060 minus 80,000. Okay, that is 800,080, like this. Then we're gonna have the ending net accounts receivable. Same thing. It is going to be something minus something, right? Just so it is a net. Let's see. For the ending net accounts receivable, we're going to have to take a look at our T account over here, right? This is our ending balance, right? But remember that this is a net, which means that we have to subtract something. You know what we're going to subtract? We're going to subtract this number over here. Because remember that over here, this is the same procedure that we did before, right? We just had the original amount of accounts receivable minus allowance for doubtful accounts. So we're going to do the same thing over here. We're going to have the original ending value for accounts receivable minus the original ending value for allowance for doubtful accounts. And that is why. So we're going to have 1,710,000 minus 115,000. That is 1,595,000 Okay, now we have this and this, so we can actually calculate the average net accounts receivable. I'm gonna call this average net accounts receivable, okay? So we're gonna have the beginning, which is 880,000, plus the ending, which is 1,595,000, and we're gonna get the average of that. So divide by 2. How much is that? Okay, that is 1,237,500. This is our average net accounts receivable. But besides that, we're also going to need 2 more formulas. The first one that we're gonna need is the credit sale formula. So we're gonna need the net credit sales formula. And what is that? That is sales revenue, or sales on account in this case, minus sales returns and allowances, right? Sales returns and allowances. I'm gonna highlight this formula here for you as well. Yellow. Okay. What is our net credit sales? Well, we're gonna have the sales revenue, or our sales on account. In this case was sales on account. That is 3,700,000 minus the returns and allowances. And that actually makes sense, right? Because I have to know how much money did I actually make, how many sales did I actually make. So I have to have like the full amount minus the amount that people returned to me, right? And this is why we're deducting this part over here. So what is that? That is 50,000. And that is going to be 3,650,000. Okay. All right. Now that we have 2 numbers, now we are ready to actually calculate what they ask for, right? Which is the accounts receivable turnover. Okay, so here, the accounts receivable turnover, the formula for that, you're just gonna divide the 2 values that you got before. So that is going to be the net credit sales divided by the average net accounts receivable. So average net accounts receivable. Okay, this is the formula. Which color do I feel like using today? I feel like using green. Okay, I'm just gonna call this ART. Okay, all right, so that was 3,650,000. And what was the average net accounts receivable? 1,237,500, right? Okay. And that, ladies and gentlemen, it is 29, yeah, approximately 295 actually, 295. And that's how you calculate it.